In this video, I'm going to walk you through on how we qualify people to get a mortgage so you can know how to get your first one. Essentially, we're going to look at three things: your income, your credit, and your assets. First, let's start with income. With income, we're going to look at what we would consider what's stable, dependable, and expected to continue. We call this your qualifying income. And sometimes it's not your total income. I'll give you an example. Maybe a part of your total income is like a sign-on bonus. Maybe your employer gave you $10,000 to sign on with them, and it's a one-time bonus. So by definition, if it's one time, it's not going to be reoccurring. So as the lender, we should not factor that in into your ability to repay the mortgage. If it's only a one-time thing, it is not going to continue. Make sense? So a lot of times people either work for a company as an employee or they work for themselves and they're self-employed. Let's go over both, but let's go over employees first. So if you're an employee for a company, the first thing I would ask is, how are you paid? Are you paid a salary or are you paid hourly? If you're paid a salary, then generally it's very easy to qualify you because salary is extremely stable, and it's even so easy that sometimes if you're a salary employee, you don't even need much work history. In fact, you could even qualify for a mortgage before you even start your job if there's a small gap in between the time that you close on your home and the time that you start your job. You have a salary offer letter and that you accept it. Interesting, right? Now, if you're an hourly employee, I would ask, how many hours do you work? Are you a full-time employee or if you're a part-time employee? If you're full-time, very easy, then we know what's stable income for you because you're guaranteed a set amount of hours and you're paid an hourly rate. Now, if you're part-time, that's where it gets a little bit tricky because your hours could fluctuate. We call that variable income, which is okay. But if sometimes you work 30 hours, sometimes you work 40 hours, what's stable for you? Well, we don't know unless we have history. And we generally look for 2-year history for variable income. So we can look in the last 2 years and we can say, yes, your hours fluctuate, but over the last 2 years, we have enough data to say on average, you work about this and that's stable for you. Now, the same thing happens for any type of bonus pay, commissions, or overtime, because that's generally deemed as variable. So sometimes you have somebody that has two different types of pay. Maybe they're a salary employee or they work 40 hours, but they also have a portion of their pay that's commissions, bonuses, or overtime. So what do? Well, very easy. We just separate the two different pay types. This is your base pay, and this is something that could be variable. And if we have 2-year history for the variable pay, then we can count it towards your qualifying income. If you don't, then maybe we can just count your base. So if you have any type of variable income and you need that for qualifying purposes, then I would recommend you have 2-year history of that variable pay. Now, if you're self-employed, then by definition, all of your pay is variable. So if you're self-employed, we're going to need 2-year history of you being self-employed. And what we look at is your tax returns, what you file on your tax returns. Whatever you tell the IRS, you got to tell us the same story. Have one story, stick to it. So we look at your revenue minus all your expenses, then we have your net pay. Now, after income, we look at your credit. So we're going to pull your credit report and see what your score is. The bare minimum credit score is 580 in most cases. However, if you have a 581 or 582, you still may not qualify because we look at the whole picture. So generally speaking, the higher your credit score, the easier it is to qualify, but the bare minimum is a 580 credit score. Now, once we have your credit report, we'll also see what kind of debts you signed up for. And at that point, we'll have two pieces to this puzzle. We'll have the income that comes in versus the monthly debts that go out. Income and debts, that gives us something that we can calculate called your DTI, or your debt to income ratio. And that's ultimately how we qualify you, off of your DTI. Now, what's a good DTI? Depends on the program, but if you have a 40% debt to income ratio, you're probably in good shape. If you have no debts, then obviously a new debt that you're signing up for is the mortgage, which will be factored in to your DTI. So again, we qualify you off of your debt to income. That's your monthly income versus your monthly debts. Now, I really want to emphasize monthly because some people think it's your overall debt or your total debts, and that's generally not the case. For example, let's say you have a $30,000 car loan and you want to look like a stronger applicant and you pay half of it off. So you go from $30,000 to $15,000 car loan. But if your monthly payment did not change, then your monthly income versus your monthly debts, your DTI is the same even though you paid half of your car off. So maybe we can use that money in a different way if you wanted to qualify for more. Now, if you ever wanted to help your DTI, there's generally just two levers you can pull, right? Your D or your I. So you either pay off some debt or you can increase your income. And an easy way you can quickly increase your income is by adding a co-signer or adding someone else to the loan. Now, after credit, we have assets or funds for closing. So we're going to look at things like your checking account, savings account. What some people do is they also take out money from their 401k or retirement and use that for the purchase. That's also counted in your assets. Sometimes people are fortunate and they can get a gift, a monetary gift from family members. That's where a family member gives them maybe like, let's say $5,000 or $10,000 to help them with this purchase. And they sign something that says that this is officially a gift. This person does not have to pay this back for any reason. And then that way we know that it's not a loan. We don't have to factor that in to their debt to income. Now, how much money do you need to buy your first house? Well, it depends on the loan program, and there's 4 major loan programs. There's VA USDA, that actually requires 0 down payment, and there's FHA loans and conventional loans. FHA, the minimum down payment is 3.5% of the purchase price, and with a conventional loan, it could be as low as 3% if it's your first house, 3% of the purchase price. Now, outside of just down payment, you should be aware of something called closing costs, which is a bundle of fees, taxes, insurance, basically a bundle of fees that's associated with this purchase that's not your down payment. This can include things like lender fees, title fees, attorney fees, taxes, and insurance. Now, a good rule of thumb, a good estimate for your closing costs is about 3% of the purchase price. Now, I would also note that in some markets, in your current market, it is possible for the seller to pay for some, half, or all of your closing costs. It just has to be negotiated. Now, I would ask your real estate agent what current market you're in, and if it's possible, and what the likelihood is that the seller will pay some, half, or all of your closing costs. But it's always good to budget that the seller will pay nothing, and then you have this in your back pocket in case you need it. Now, lastly, with assets, I also want to note that there's a lot of down payment assistance programs out there. And if you're interested in down payment assistance, I would talk to your lender and ask them what's available and what's the pros and cons of using someone else's money versus my own. Okay, so let's summarize. Whenever we're qualifying somebody for a mortgage, we look at their qualifying income, which is sometimes not their total income. Depends on what type of pay it is and if that pay fluctuates. And if it fluctuates, do they have 2-year history receiving it? We look at their credit report. What's their credit score? Bare minimum is 580 credit score. The higher the credit score, the easier it is to qualify. From the credit report, we can see what kind of debts they signed up for, and then we can calculate something called your DTI, or your debt to income. A 40% DTI or lower is generally you're going to be in great shape. However, you could go a little bit higher than that depending on the program and your credit score. And as far as assets, how much money do you need for closing? You need anywhere between 0 to 3.5% for the down payment. There is down payment assistance available. I would ask your loan officer what programs are available, but 0 to 3.5% depending on the program. And for closing costs, you should budget about 3% for closing costs. Now, remember, sometimes you can negotiate the seller to pay some, half, or all. I would ask your agent what kind of market you're in, but I would budget 3% in my pocket in the case that you can't negotiate the seller to pay.